Hello and welcome to this lecture on gaining an understanding of the client system of internal controls. I'm your guest lecturer today. My name is Paul Hewitt. I'm a manager at Grant Thornton in the Audit and Assurance Division. A bit of background about myself. I started at Grant Thornton in 2015 as a graduate, and during my time at Grant Thornton, I've worked on a range of different types of clients, from small not-for-profits to large listed companies. I've also completed and obtained my chartered accountancy. I did my undergraduate study at Bond University on the Gold Coast, and that was my only time out of Melbourne. Otherwise, I've been born and bred in Melbourne. And I went to the Knox School, which is out in Wantirna South in Melbourne's east. Our learning objectives today, we've got 7 of those, which we'll cover across. In the next half hour or so, it's important that we link back what we've been talking about to these learning objectives, as that's going to help you on your assessment. So first of all, a definition. What is internal control? So internal controls is the process designed, implemented and maintained by those charged with governance, management and other personnel to provide reasonable assurance about the achievement of the entity's objectives with regards to the reliability of financial reporting, effectiveness and efficiency of operations and compliance with applicable laws and regulations. So that sounds like quite a mouthful, and hopefully through the remaining slides that will start to make a bit more sense and start to come back to what that means from an audit perspective and how it all comes together. So this is a bit more of an internal control definition, a bit more of the practical, what it actually means. So internal control encompasses the entity's resources, systems, processes, culture, structure and tasks. When controls are effective, the entity is more likely to achieve its strategic and operating objectives. So I guess what you're probably all thinking at home is, well, so what? What does this mean from an audit perspective? How does it all come together? So the key that we've got to think about here is the audit focuses on the controls with a direct impact on entities' financial reporting, compliance, and asset safeguarding. So that's a quote from the auditing standards. But what we basically mean is, if internal controls are functioning appropriately, it gives us more confidence that the numbers in a particular area of the financials are going to be right. And if they're not working appropriately, well, it increases our audit risk as essentially areas which things are likely to go wrong because there's nothing stopping them from going wrong. So what are the objectives of internal controls? So there's 7 objectives of internal control, being real, recorded, valued, classified, summarized, posted, and timely. And what we're just going to go run through here are the definitions of these different objectives. So real. There are controls in place to ensure fictitious or duplicate transactions are not included in the books or records of an organisation. And that one's really important. As an auditor, if there are fake or fictitious entries in the accounting books, finding how many there are, the quantum of those, is an extremely difficult task. So ensuring that there's only real transactions in place and controls to stop that is one of the most important ones from an audit perspective. So recorded. There are controls in place that will prevent or detect the omission of transactions from the books and records of the organisation. So this is basically the opposite. So we're real, we're worried about everything being there being correct. So your existence assertion. Recorded about is more along your complete assertion. So are the boards and records all there? So what's a classic example of something that might fall into this? Take a small business where they don't want to record a sale because they want to do it on the side for tax purposes. Has anyone ever had a tradie come up and ask for cash and giving you a discount? So that's an internal control for that business. Recorded is what we're looking at. There's controls in place that make sure all the sales, for example, go through the books. There's nothing sneaky on the outside. Valued. There are controls in place to ensure that the correct amounts are assigned to the transaction. So how would this apply in real life? So let's think of an example where I'm making a sale to my best mate for goods and services, and I want to offer him a discount because he chose our business. Are there controls in place to stop every employee doing that? Our next objective, classified. There are controls in place to ensure that the transactions are charged and allocated to the correct general ledger account. So where this comes into play, Obviously, you all know your definitions of what's an asset, liability, expense, revenue, etc., equity. We've got to make sure that there are controls in place that we can't hide stuff. So this would be preventing, say, a revenue transaction ending up in expense, or putting expense as offsetting revenue to bury the fact that we incur these expenses, which would be misleading to users, which is why we care from an audit perspective. The next objective is summarised. There are controls in place to ensure that the transactions of the books and records are summarised and totaled correctly. Posted. There are controls in place to ensure that the accumulated totals in the transaction file are correctly transferred to the general ledger and subsidiary ledger. And timely. There are controls in place to ensure that transactions are recorded in the correct accounting period. So this is really important around the end of financial year, and sometimes it's month end or quarter end. Why is that important? Obviously for listed companies, there's reporting pressures for the market, but also you've got to think of lots of businesses, say car dealerships, will be incentivized based on quarterly or annual targets. So there's an incentive for sales staff and business staff to mislead users of their financial information on when transactions occurred in order to meet bonus targets. So there are controls in place to ensure that transactions are recorded in the correct accounting period. It's really important from an audit perspective because of the flow and impacts to other aspects of the business. Now, each of those objectives of internal control, being real, recorded, valued, classified, summarised, posted, and timely, help us to test assertions and gain comfort that the assertions on financial statement level are appropriate. So just a refresher from your previous topic, our accounting assertions are occurrence, completeness, accuracy, cut-off, classification, understandability, existence, rights and obligations, and valuation and allocation. So what we're going to do on the next slide is we're going to have our objectives of internal controls on one column, and we're going to have the assertions that they help us cover off on the next one. So hopefully, if I did a good enough job of explaining what our objectives of internal controls are with some of those practical examples, this hopefully will be a nice, easy task that you can play along at home. Okay. So as I explained, we've got the objectives of internal controls and the assertions they help us cover off. So what assertions do real cover off on? Have you got a guess at home? So real. So this is occurrence, which I indicated when I was explaining this one. Rights and obligations and existence. How about recorded? Accuracy, completeness, and valuation and allocation. Again, hopefully that makes sense based on the example that I gave explaining those two. Valued, accuracy, valuation and allocation. Classified, accuracy, classification, and valuation. Summarized, accuracy, valuation, and allocation. Posted, accuracy, classification, and valuation and allocation assertions. And last of all, timely, I mentioned cut off, so there's no surprise that that one was cut off. So as a bit of a summary, objectives of internal controls. From an audit perspective, the audit is going to aim to gain an understanding of how the client uses internal controls to meet objectives. Focusing on these objectives helps the auditor select controls for testing and gain greater assurance that the controls are operating effectively. Failure of intended use controls to meet any of these objectives is a weakness in internal control. And how this all comes together we're going to go through in a later slide. But for right now, at a high level, if you think from a really simplistic example, you want to make sure that revenue in the financial statements is tested appropriately. If you know there are controls in place across the business, across all the people involved in a revenue transaction, and they're functioning smoothly, your testing is tailored from an audit perspective based on a knowledge that these controls are operating effectively, so you can target your testing to meet specific objectives. If there's a weakness in the internal controls, your testing is going to have to change. How are you going to gain comfort where there's a breakdown here? What if this goes wrong? How are we going to gain comfort that's right? And hopefully that will come a bit more clearer when we run through an example. On the other side of things, what are inherent limitations? No matter how good a business is, there's always going to be limitations with their internal controls. Generally, the bigger a business is, the better their internal controls can be, because they have the ability to segregate duties more amongst people of the team, clear silos of operations, and separate IT teams and support teams that can handle admin functions to provide the best control environment. That's not to say a small business can't have functioning internal controls, but generally the level of controls they have is likely to be slightly different. One that's going to be a limitation that's going to be existing at all levels of all businesses is human error that results in a control breakdown. Now, this is not fraud, this is just human error. We've all done things wrong in the morning, we've taken the wrong train, we've missed our alarm. Human error applies to accounting as well. We click on the wrong button in the accounting system. We add an extra zero. We misread a number. We misunderstand an instruction. So human error happens. Good internal controls capture that before it flows through. Ineffective understanding of controls purposes. If people don't understand what they're doing, they're more likely to make an error. Collusion by two or more people to avoid controls. Now, this is a really hard one, and this does happen in businesses where people will work together to get around controls. Sometimes it's for an honourable purpose. I use quotation marks for that. Someone's away and they need to get something done, so they find a way to get around the control. But often it's for a sinister purpose. We can get money out, we can pay fake invoices. Software programs control being overridden and disabled. This is one you can often see in a small business scenario where the functionality for designing and implementing controls in the accounting system is given to a member of the finance team who suddenly has too wide a brief and is able to get into the system and do things undetected. In bigger companies, often the control of the accounting system will be given to an IT function and kept separate, but there's always a risk that software programs controls are being overridden or disabled. And also the last one is management decisions about nature and extent of controls being implemented. Okay, so the next area we're going to look at is the entity level internal controls. Now, entity level internal controls potentially impact all of the entity's processes across all lines of the financial statements. So we can group those into 5 buckets: the control environment, the risk assessment process, the monitoring of controls, IT communication and systems, and control activities. So we jump into the first area, the control environment. So this is the attitudes, awareness, and actions of management and those charged with governance concerning the entity's internal controls and its importance to the entity. Now, this can be demonstrated in a number of different ways. So for the first one, communication enforcement of integrity and ethical values. This can be as simple as the CEO speaking to people, reminding them to act ethically, act appropriately. Now, that sounds really simple, but a classic example that's been reported on a lot in the last few years is the banking culture, where there's a high level of sales-driven culture which pushed sales staff to meet aggressive targets and force potentially inappropriate products onto vulnerable consumers in the Australian environment. So a culture actually can have a big difference on the control environment. Other elements that we could look at, the commitment to competence. Have we hired the right quality of people to perform their role? For example, is our financial controller appropriately qualified with the appropriate experience and understanding the industry to fulfill their role and ensure accurate financial information is prepared? The organisational structure. Are there enough people in the right role so we can have appropriate segregation of duties? People are, again, qualified in their role. Assignment of authority and responsibility. So this again can kind of come back to our segregation of duties. Are the right people in the right roles? It's essentially our foundation for effective controls. Controls are only as good as the people that design them, implement them, review them, and then monitor them on a daily basis. Our next entity level control area, the entity's risk assessment process. The entity's process for identifying and responding to business risks. Controls are going to be targeted and focused on areas where the business expects potential errors or the most important parts of the business and its key processes. So The business needs to have the people in place to identify what the risks are and help respond to those risks. You might be able to identify a risk, but if you don't respond to the risk appropriately with your controls, the risk is still going to be there and not mitigated, and then we've got a potential for error. The next area, the information systems and communications. So it involves capturing and providing information to management and employees so that they can carry out their responsibilities, including providing an understanding of individual roles and responsibilities as they relate to internal controls over financial reporting. Now that sounds like quite a wordy explanation, but essentially we've got to think of, does the IT system provide the structures for the control environment to operate effectively? So if we've identified that the person inputting an accounts payable invoice into your accounting system, say 0, should they be the same person that's able to pay that invoice? Now common sense would say, well no, you want separate people, so there's separate people doing different parts of that payable process. So no one person has complete control, and therefore the risk of an incorrect invoice being paid could come into play. So what IT systems allow us to do is prevent that from happening. So if I upload an invoice, only someone else can approve it for payment. So the system automatically is preventing a potential risk of me paying a fictitious invoice. Our next entity level control area is control activities. So these are the policies and procedures that help ensure that management directives are carried out. Control activities are a component of internal control. Generally, control activities that may be relevant to the audit may be categorized as policies and procedures pertaining to the following: performance reviews, information processing, physical controls, and segregation of incompatible duties. And last, but potentially the most important, is the monitoring of controls. So after establishing and maintaining internal controls, an important responsibility of management is to monitor the controls to assess whether they are operating as intended and modify for changes in conditions on a timely basis. Now this is really important. You may identify a risk in the business that requires some internal controls to help prevent something going wrong. You may think you've come up with a fantastic solution and implement it, but unless you review it and assess whether it's actually had its desired impact, you risk the control going horribly wrong and doing absolutely nothing. Also, the other element of monitoring control that's really important is if things change from year to year. So if you check a control is working at 30th of June 2019, you also need to make sure that the control is working at 30th June 2020 from an audit perspective. Businesses will have slight evolutions, staffs will change, systems will change, processes might change slightly. So from an auditor's point of view, we need to check the controls annually to make sure they're operating effectively. Largely controls will stay relatively consistent, but there are always elements we've got to check whether they've changed. From a management perspective, they need to be monitored on a regular basis every time there is a change to make sure the control is operating as intended. So, what about small entities? So as I touched on before, there's a difficulty to implement formal controls and segregations of duties in small entities, purely because they don't have the same number of people to segregate duties between. There's often, in smaller businesses, a reliance on owner-manager who's heavily involved in the business. So this person will be able to bypass the controls or do things their way, which increases the risk of something going wrong. So from an audit perspective, what does this mean to us? So one option is to increase substantive procedures to compensate for weaker controls. So this may be vouching more items to invoice to make sure they've been input correctly. As an auditor, over all the entity level controls, the auditor must make an overall assessment of the effectiveness of internal controls. Now, entity level controls are controls, as I touched on, that encompass the entire financial statement process. So it's going to impact revenue, it's going to impact expenses, it's going to impact cash, it's going to impact trade and other payables. So when we make this assessment, it's very, very important because it impacts the overall phase of the audit. So, we've looked at entity level controls. What about transaction level internal controls? Now these are controls that impact a particular transaction or group of transactions. They are aimed at preventing an error from entering the records or detecting errors that do enter the records. So, when gaining an understanding of the transaction process, the auditor will identify the major events and transactions in the process, identify risks to the correct processing of the transactions. We call these what can go wrong. And we'll touch on this very shortly around how this actually comes together. For each what could go wrong, the auditor will identify one or more controls, and this understanding is documented and used to guide evaluation and testing of internal controls. So, this is going to come together best using an example. So, this is what we're going to look at. We've got sales processing orders. So at the very beginning of a sales transaction, someone has to make an order. So, what could go wrong? In this instance, what could go wrong? We're thinking orders are processed to the wrong customers. It's a very real risk. So, this is the transaction that we're looking at. We're processing sales orders. We've identified orders are processed to the wrong customers as a potential risk of what could go wrong and produce inaccurate financial information. So then as auditors we think, what could stop that from happening? So we came up with two controls in this instance. So a review of orders processed each day by an independent staff member. So if we're talking about a business that processes 150 orders a day, it's probably not practical for an independent staff member to look through all 150. So the control could be for any sale over $10,000, an independent staff member matches the order to the actual sale. Further, a three-way match of orders, dispatch documents, and invoice prior to dispatch. So this is probably a more common one that you see on a lot of clients that will be shipping goods. So normally, and this one is so effective because it's normally spread across multiple people. So for this one, what you'll often find is Sally in the call center takes the order from customer Joe that they want 100 mobile phones. They'll input that into the system. The warehouse staff will then receive that order saying they have to pick 100 mobile phones for Sally. They will then pick the 100 phones and prepare them for shipping with the dispatch document. They then key it back to Sally in the ops room to issue the final invoice. As part of that process, the salesperson, Sally in this instance, confirms that the order is for customer Joe for 100 phones and it's going to the right address. And what assertion will these controls help the audit team cover off on? Occurrence and accuracy. Did the transaction actually occur to the right person, and did we record it accurately? So with a sales processing order, what else could go wrong? Orders are taken from customers with no credit history or credit limit. This could also apply to customers who have a too high credit limit. But in this instance, we're looking at specifically no credit history or credit limit. So application control that will only allow orders to be processed against customers with enough unused credit limits. So what does this actually look like in practical terms? What you'll often find is when a new customer wants to purchase items on credit, a credit manager or an AR manager will run a credit check, get it approved by the CFO or the CEO, allowing customer X to have a credit limit of $10,000. That information is then uploaded to the system, and an order is only allowed to be processed to customer X when the value of that order is below $10,000 or doesn't exceed the outstanding amounts of $10,000. What assertions is that going to impact? The occurrence and accuracy assertion again. What else could go wrong? Orders are input incorrectly. I think that should actually read. Sorry for that. So typo on my behalf. So this is a classic human error, which we said was an inherent limitation back on a previous slide. So what controls could we put in place to stop that? We could require an acknowledgement for orders by customer for any orders placed of over $5,000. So in this instance, the system would trigger an amount a notification to the customer saying, do you confirm this order? So many times you see sales with an extra zero or a dot point in the wrong place. So the system notifying the customer to confirm the order, this helps prevent that error from happening, and that obviously impacts the accuracy assertion. So we keep working through the transaction level controls and how it looks. Our next one is sales, approving credit. We kind of touched on this in the previous slide, but we're just going to expand on it a bit more now. So what could go wrong with approving credit? Credit is approved for customers unable to pay. This is so topical right now, given what's happening with coronavirus. Cash flow is very important for a number of small businesses, paying wages, paying suppliers. So as a business, this is probably front in mind for a lot of businesses right now in their control environment. They do not want to provide large-scale orders, which they're not going to get paid for, because then their business is going to be in trouble. So what could go wrong? Credit is approved for customers unable to pay. So how are we going to stop that from happening? Credit committee review and approve all applications for credit over $1,000. So this is kind of like the example I provided on the previous slide, where when a new customer is set up, the credit committee or the CFO or the CEO, depending on the actual control, has to approve it, and then that's uploaded to the system. And the assertion is accuracy. In the current environment of, say, the corona environment world, where cash flow is tight, just setting up a customer with a credit limit at adoption, that needs to be constantly reviewed. So customer X may have been set up in the system 2 years ago, and we've never had any payment issues, and the credit limit's $50,000. Is that appropriate in the current environment? Should we only be giving them credit of $10,000 so if something goes wrong, we're not out a large-scale dollar amount? Do we make them pay up front? These are all things which approving credit suddenly has become really important. So our next what could go wrong ties into this. Credit limits are set too high or too low. So credit committee review credit limits on a quarterly basis. Now those quarterly bases, we're almost at the end of March, so it could be a very timely quarterly review for the credit committee. But again, these need to be reviewed on a rotating basis. And now this might be on a month end. You might have your AR person reviewing the listing and notice that customer Y has a large amount outstanding over 90 days due from when it was due. This may prompt a review of credit limits being too high as well. And the assertion again is accuracy. Credit limits are exceeded. Application control requires approval for exceeding credit terms. I've had customers tell me that they've got this control in place, yet the credit limit can actually be exceeded. So there's one thing to document a policy and say the credit limit is $10,000. There's one thing to make sure the system actually limits it to $10,000. And who has the override? If your biggest customer has really good cash flow and they want to make a really big order, and the system says, no, you can't approve it because the credit limits are exceeded, you need to have a way to get around that control. But it needs to be only done by the right person to prevent that happening regularly. And again, this is the accuracy assertion. So I've got one more transaction level entity controls examples. And our transaction we're looking at is inventory, recording inventories on hand. So what could go wrong? Inventories are recorded in the balance sheet that do not exist. And how do we think we can potentially combat that? We can perform a stock take on a quarterly basis. What assertions is that going to count? The existence of stock and the accuracy of cost of sales. There's a risk that you've sold goods, taking credit for the revenue, but not shown the stock leaving. There's also the risk that someone's stolen stock. So performing stock take on a quarterly basis helps to ensure what actual stock do you have on hand at this date, and is a very common practice. The wrong quantities are recorded during a stock take. Again, human error. This can happen a lot. It's very easy to miss an item, not look behind an item. So how do you combat that? All stock is double counted by independent teams. Team 1 counts the item, Team 2 counts the item. Alternatively, generally you know roughly how much stock's left. There's meant to be 10 left. The team counts 2. You get a variance of greater than 10%, another person goes and double checks that count. What assertions? Accuracy. Our last what can go wrong, goods that have been sold or invoiced are included in the inventory on hand. How do we stop that? Review perform on all variances greater than 10%. and your assertion is accuracy and cutoff. Now, from an audit point of view, you often will attend stock takes to make sure the processes or the example controls are actually being implemented effectively. But again, what about in a coronavirus world where going out to attend a client stock take, the client doesn't want us there for health reasons, or we don't want to attend because of the health risk to our staff? We're already seeing clients having to film the stock take for us. One person films and we observe the counts taking place. And we perform test counts as well, which we can do visually. So technology is allowing us to still test these controls in a changing environment, which is going to evolve over the next few months, 100%. So as an auditor, once we've thought about what controls are in place, we've identified the controls and had discussions with management, we then need to document the internal controls from our audit perspective. So what does it look like on an audit file? There are two main options and a combination option, which are the most common ways to document internal controls. So number one is a narrative. It's very useful when controls are simple, straightforward, and an audit basically will just describe step by step what's taking place. The next option is a flowchart, potentially for more complex controls, but also keeps it relatively simple. So you'll have step A flowing to step B, flowing to step C, and it's very clear to see the process and the controls that are in place. The most common one I see is a combination of flowcharts and narratives. So you use both side by side. You might have a flowchart to summarize the process and a detailed description step by step in a narrative, working side by side. Now, another one that often exists is a checklist performed. So when identifying what's missing, it's often good to compare back to a checklist to make sure that each risk or potential issue you've identified are being addressed by different controls. It's useful also for less experienced auditors to see what might be missing when they haven't seen what a good control looks like. And it's often used in an environment where regulatory requirements require a higher level of internal controls or specific internal controls to exist. So, some examples of what this actually looks like. So, up here we have a narrative describing part of the process. Down here you have a flowchart. So often what you'll see is a flowchart, but a narrative supports each step. So for example, you'll have this step here being supported by this more detailed. Now down the bottom right here, we have a checklist style. So do they have this? Who does it? Is there a reliance on electronic data? Yes or no? These will all generally work in combination with each other. So, once we've identified controls, we've documented the controls, it's then time to reach a conclusion from the audit perspective. So we need to identify the strengths and weaknesses in the system of internal controls. So, any weaknesses that impact the financial reporting process, we will care about. We need to draw conclusions about the control risk. Significant levels of professional judgment are required when determining the observation and whether it should be tested. So just because we've identified a control doesn't mean we're going to test that control. But also if we find a control gap, we've got to identify how's that going to impact on the financial reporting, but also there might be a control missing from what we would normally expect, but is there a compensating control elsewhere that might help prevent the risk? So the greater understanding we have over the entire control process, the better it allows our conclusion to be drawn. And now this is a summary from the standard. So the auditing standard 260 requires auditors to provide those charged with governance timely observations arising from the audit that are significant and relevant to their responsibility to oversee the financial reporting process and to promote effective two-way communication between the auditor and those charged with governance. So, how does that look like? The most common form that we will report control finding is through a management letter. So, letters from the auditor to the client, recommendations based on internal control assessment findings and other matters is a requirement under ASA 260 and ASA 265. So how does this look? From a Grant Thornton perspective, we prepare at the end of every audit an audit findings report which gets presented to the board. In that, we'll have a section on control findings where we'll identify the issue and a recommendation. Management is then provided an opportunity to provide a response, and those three fields are then presented to the board for their review. So how might this look for an example? If every cash payment requires 2 signatories, that is a client control. But when we obtain a bank confirmation, which is a statement directly from the bank to us as the auditor, outlining the bank balance and the signatories, we often find that only 1 signatory is required. Even though the business would like to be 2, the bank actually only needs 1. So what would our issue be in this instance? Our issue would be for bank account X, only 1 signatory is required. The recommendation is pretty simple. We recommend the bank be contacted to ensure that 2 signatories are required for each cash payment. Management response to something like this might be as simple as, we will contact the bank immediately to rectify this issue. And then when that's presented to the board, they can inquire of the audit team what our observation was, why this may have happened, and management provides their response. There's professional judgment around which matters to include in the letter. So this comes around by discussing with management the compensating controls, from our testing, to a lot of factors at play. That wraps up our lecture on internal controls. Thank you for watching. Hopefully I wasn't too boring for you. If you're interested in a career in audit or accounting in general, do check out the Grant Thornton Careers website. If I was there presenting in person, I would take opportunity to ask any questions. So if you do have any questions for me about the content, any of the examples I've gave, or just accounting in general, or potentially applying to Grant Thornton, feel free to reach out and add me on LinkedIn. I put my address there. Feel free to add me and message me if you've got any questions. Otherwise, stay safe in this current environment and good luck with your studies. And thank you very much for your time.